This is part 3 of our Chapter 2 video lecture series, where we're going to record the same transactions we saw back in Chapter 1, but this time using the rules for double entry accounting. That's increasing and decreasing accounts using debits and credits, versus using this accounting equation table where assets are equal to liabilities and plus equity. And each column here represents accounts, either decreasing minus or here increasing with a plus, but not plus or minus anymore. We're going to be using debits and credits. So this is the rule of how to, in this case, increase all the different types of accounts. If you're dealing with an account that's an asset or an expense or the dividend account, if you want to increase those types of accounts, you would enter the dollar amount on the left side here of the T, the debit side. Or if you want to decrease the cash asset, don't debit cash, but you're going to credit the opposite here, crediting that cash account. Or if you owe accounts payable, even more now accounts payable you owe, that's a liability. You would record that increasing amount on the credit side. And if you pay off the liability, you want to reduce it. So that payoff would be recorded to the liability on the debit side, reducing the liability. Again, what you see on this screen is the rule to increase all the different types of accounts. And you do just the opposite if you want to decrease these accounts. So let's take a look at the first transaction we're given back in Chapter 1, where we had the company, fast forward, it's receiving $30,000 of cash from the owner, Chas, who's going to be receiving common stock of the company. When you take a point of view and recording your transactions, you're always going to be viewing it from the viewpoint of the company here, fast forward, and not the owner, Chas. It's the company receiving the money here. We have to increase that cash asset. We learned that cash assets are increased with debits. So here in this yellow box, the general journal, we're going to record the date it happened. First of the two different accounts, the account being debited in the first row, and then the amount of the debit here in the debit column. Then in the next line, we indent and record the name of the account that has to be credited. Remember that double entry accounting requires at least 2, maybe even more accounts changing in any single transaction. And the dollar amount of the debit and the dollar amount of the credit has to be equal to each other. Otherwise, there's a mistake right there. Here you can see we're posting right away into the ledger accounts represented by these T's. The real ledger account would look like this here for cash. Here you can actually even see the T if I draw it in for you. Debits, cash as an asset, these are increases to the cash assets. And credits, this is decreases to the cash asset. Remember, that's the rule. Assets are increased with debits, increase, and opposite side, decrease with credits. Okay, so again, back to that transaction. Okay, so we journalize it here in the general journal, and we post it to the ledgers to update the ledger accounts here. Let's take a look at the second transaction where our company pays. Right away, I would go to my cash account and credit, right? Cash, you're decreasing the asset with credit. But here, we're paying for supplies, which is another asset, just like cash. But because one is increasing and one is decreasing, we know one has to be debited and one has to be credited. And again, the rule for assets, all assets, we increase them, increasing supplies with debits and decreasing the cash asset with a credit. So now we post it to its respective ledger account here. And if you want to know how much cash you have left over now, you have to take the difference between debits and credits. When you have a bunch of debits in one account, you always add them together. When you have a bunch of credits in one account, you would always add them together. But if you have debit and credit in the same account, you always take the differences between the two. You never add them. So the difference here would be that looks like $27,500 left as a debit cash balance. Okay, let's take a look at transaction number 3, where we pay. Again, we are the company point of view. Pay means cash credit, 26,000. If I know I have to credit cash, the other account I'm dealing with has to be a debit. Otherwise, I'm not balancing in this one transaction. In this case, it's an asset, and this equipment asset is increasing, and increases to assets are recorded with debits. Again, we first journalize the transaction. Debit first, credit second. Again, notice the indent here to indicate this is a credit, and the amount of the debit and credit, and you post it to its respective general ledger account. Again, each one of these T's is one ledger account, and combining all the T's for all the accounts is called the general ledger. So now, if I want to know how much cash I have in my cash account, I would add up all the debits, I would add up all the credits. That's 28,500 total spent, and I take the difference. And sorry, I cannot do that in my head, but I know it's more debit balance left over, yeah? The normal balance is the same as a positive balance, in this case, a debit balance. Also notice that we have account numbers here, so we go back to the journal and indicate that the posting is completed by entering the account number here in the cross-reference or posting reference column. Okay, transaction number 4, we're purchasing supplies, but this time not by paying cash. I don't see cash here anywhere here in this screen, but I'm borrowing the money. They call that on account or on credit, $7,100 worth. Now you don't wait till you pay for the supplies to record the transaction. You bought it right now, so you got to record it now. Supplies is an asset. This asset is increasing. Supplies has to be debited to increase it. And I know whatever other second account I'm doing has to be a credit. In this case, not cash. I didn't spend the money yet. Spending the money later on is another transaction that has to be journalized separately from this purchase. So right now, I owe the money. Owing the money is a liability. A liability account is increased with a credit. And the name of this general liability account, this common liability account, is called accounts payable. So I journalize and I post. Posting is the correct term when you transfer the numbers, the amounts from the journal into the respective ledger accounts. Transaction number 5. I see I'm receiving some cash here. We're selling our consulting services. So I give my customer my bill, my invoice. Okay, and that means I earn the money. And right away, I collect that $4,200. I'm increasing my cash asset with a debit. That's the rule for assets. All assets increase with debits. And I know the other account has to be credited, really showing you where the money came from. Not from borrowing from a liability, not from the owner investing through common stock, but this is the main way we want to receive money, by earning it. And this is the account that represents the earning for this specific company called consulting revenue. Revenue increase with credit. You post the debit, you post the credit. So the most common account you usually post to is the one that has lots of transactions, typically the cash account. But here, we've just earned a bunch of money, okay? And the money did come in at the same time. Transaction number 6. I see the word pay here right away. Cash credit, yeah? Cash credit. And then the other thing is now I have to record the debit. So now I got to read the rest of the description here. It's for rent and for the current month, yeah? So that cost is pretty much used up already. And that's the definition of an expense. Cost that has been used up. It's not going to have any future value. So we're going to deduct it right now in this period of time, December. So expenses, we learn. What's the rule again? Expenses, we're increasing it, and that's done with a debit. Debiting rent expense and reducing the cash asset. Okay, post a debit, post a credit. Next transaction, number 7, pay again, cash credit, cash credit. And then what am I paying this for? Here to employees. So that's their wage or salary. That's another expense. Expenses recorded with debits. We journalize the two accounts and we post it to its respective general ledger accounts. Transaction number 8. We provide some more consulting services to our customers, to our clients, and we also earn some rent income. Maybe we're subleasing some office space that we're renting out from somebody else. But we didn't get the money right away. We gave the customers, our tenant, the bill. But here, we're extending credit to them. They're going to pay us later on. But you don't wait later on to record earning this money. You've earned it already. You just didn't collect it yet. Collecting the money is another transaction that has to be journalized later on when you do receive the money. In the meantime, here's the revenue, two different revenue counts being recorded. Both increase with credits. Again, the rule is revenue increase recorded with credits. So another account has to be debited. Another account has to be debited. And it cannot be cash because we're still waiting to collect the money. Here we have the right to receive the money. And that account is accounts receivable. Okay, increasing this asset. Assets increase with debits. So total debits are equal to total credits. In this case, 3 accounts are changing, not just 2. The rule is at least 2, maybe more. We journalize in the general journal and we post to the 3 respective general ledger accounts. Transaction number 9. Receive cash debit. Why are we receiving it? Here we're collecting $1,900 from a customer that we built back in the previous transaction. So now we're collecting that consulting fees. So cash debit. And now the credit is not to revenue. That would be double counting the same revenue that we recorded back here in transaction number 8. So a customer doesn't owe us this $1,900 of receivables anymore. So reducing accounts receivable asset, you got a credit. Again, the rule here is everything increasing. I'm decreasing that accounts receivable asset. I got a credit accounts receivable. I got to credit accounts receivable. Okay. Transaction 10. Here we're going to pay off part of our account payable liability. This was way back in transaction 4. I guess we're paying off the whole thing. This was for supplies. And now here's the money going out, cash credit. But the debit is not to supplies because that would be double counting the supply asset. We don't owe this liability anymore. We don't owe $900 inside of this amount here. So we're going to pay off, reduce the liability with a debit. Again, the rule, increase liability with credit. Well, I'm reducing the liability. So I got to debit this liability, accounts payable liability. Here's the last transaction we saw back in chapter number 1. Our company is paying cash credit, a dividend. Okay, so we got to record a dividend. And the rule is dividends are recorded increase with debits. Dividend debit, reduce cash asset credit, and you post. Now here is a new transaction, number 12, we didn't see back in chapter 1. We're receiving cash credit, $3,000, but this money is being collected in advance before earning the money. We can't record earning it because we haven't provided the services yet. That's going to be done in the future. But you got to journalize the transaction. You got the money. Cash has to be debited. But the credit is going to go to a new account we're learning here in chapter 2. Not revenue, But the key word here is unearned revenue. Unearned means you owe something back to your customers, in this case, consulting services, and you haven't earned it yet. You owe it to them. Owing something is a liability. A liability is increased with a credit. This is one of the few liability accounts that doesn't end with the term payable. When you see unearned, that's a key to indicate that the account you're dealing with is a liability account. Here, increasing, we owe something to our customers, $3,000 worth of services. New transaction, pay, cash credit, here for insurance coverage. And we got to pay in advance. Looks like 2 years worth of insurance. So we're not going to treat the whole thing as an expense because it's not all used up yet. It's going to be used over 2 years. So right now, what we're paying is for an asset that's going to be used up in the future, used up over 2 years. So here's the cash going out. That's the easy part, cash, asset, credit. But in exchange, we're getting back another asset increasing here, debit, called prepaid insurance. And as the months go by over the next 24 months, we're going to be using up this prepaid asset and converting it into an expense, an insurance expense. But we'll learn that journal entry next chapter, chapter 3. One more, another transaction, purchasing supplies for cash. We kind of did this before. Spend cash, credit cash, increase supply asset, debit. Okay, you journalize and you post. Transaction 15, we're going to pay for utilities. So you got the bill and you paid for it right away. Pay, that's cash credit. In this case, the utility benefit is all used up already. You're not carrying it over to next month, so you got to deduct it as an expense now. Expenses are recorded with debits. You journalize here in the journal, and you post it to our respective general ledger accounts. Okay, let's see. Next transaction, we're going to pay our employees. So cash credit, asset reduce, and expenses increase with debit, specifically the salaries expense. Journalize and post to the two accounts. So that's all the transactions we have for the month. So what you got to do, here you can see all the T accounts, yeah? And again, this is just the T portion of the journal ledger accounts. You add up all the credits, you add up all the debits, and you take the difference between those two subtotals. And here, because of assets, you gotta normally have more debits than credits. The leftover balance is how much you have in this account at the end of the month. You take the difference between these two, and here is what you have at the end of the month, 0. Nothing owed to you by customers, nothing receivable from customers. You add up all the debits here, and here's how much supplies you purchased during the month. Now, we know we're going to be using up supplies during the month, but we haven't reduced that supply yet with a credit. That's a journal entry we're going to learn called an adjustment in the next chapter, chapter 3. Here's how much insurance we bought that's going to be used over the next 24 months, an asset with a debit balance. Equipment we bought, debit balance. And then 2 liability accounts. Normal balance are credits. Remember, positive increase with credits. We owe general creditors accounts payable $6,200. And we owe our customers who paid us in advance $3,000 worth of services, consulting services. Here's the amount of common stock we issued to Chaz. And here's the amount of dividends we paid back to him during the month. Revenue we earned from consulting, total balance. Here's the rent income we earned and collected, total. And then salaries we paid during the month, 2 times. And rent we paid, utility expense we paid. The numbers I just mentioned or pointed out in bold here are the balances we have at the end of the month. And what we're going to do in the next video is take those balances and put it on a document called a trial balance that is very useful to accountants. It's not the same thing as those financial statements, which we'll also cover in the next video. Okay, so we're looking at the general ledger here and recalculating all of the ending balances. Notice we add up all the assets total, add up the liability balances total. And here's the equity, including the revenue and minusing the expenses, minusing the dividend total. And just like we learned at the beginning of chapter 1, total assets have to equal total liabilities plus the equity. Otherwise, something is wrong. Maybe you have to go back to the very beginning and make a correction. But continuing to our last video, where we're going to prepare that trial balance from these bolded numbers here and the financial statements. One more time.